Hey everyone, what's going on? This is Adam here, and we were about to close this FXI position, and I just wanted to record a video to kind of explain this trade a little bit because, it's a butterfly. It's not our typical strategy that we trade, and it kind of seems to trip some people up about understanding the pricing and everything like that. So let me try and explain. So this is a butterfly, and as you guys know, from the options trading course, a butterfly consists of buying one option, selling two options, and then buying one option at a further strike. So what it would look like is if we just click buy butterfly, you can see basically you sell the body, so you're selling two of the middle strike, and then you buy one of each wing. So sell the body, buy the wings. Hopefully that made sense. If it didn't, make sure you watch the chapter or the video in the options trading course in chapter 7 for the butterfly. So anyways, let's talk about this trade. This is a trade in FXI. There are 8 days left to expiration, and you can see with this butterfly, our strikes are not symmetrical. Right, so we bought one of the 39 call, sold two of the 40 strike call, but you can see there's a big gap in between for the other strike, right? So we call this a broken wing butterfly. And the reason we did this, the reason we skew the strikes like this, is because this allows us to trade the butterfly at a negative price. We get to buy the butterfly for a credit, basically. And this is where people get tripped up. This is where people get confused. So let me explain this the best I can. You can see our trade price for this butterfly is negative 19 cents. And remember, whenever we trade butterflies, we buy them as an opening trade. So the simplest way to think about this is with any asset, we want to buy low and sell high, right? If we buy a stock, we want to sell it at a higher price than we buy it for. Okay, so the goal with the broken wing butterfly is we buy it at a negative price and we sell it at a positive price, right? A positive number. You can see the spread is currently at plus 10 cents, right? That's a positive number. And this, 10 cents is certainly higher than negative 19 cents. Let me just give you another example. Let's say we buy it at negative 19 cents. If we sell it at negative 10 cents, then we made a 9-cent profit, right? Because negative 10 cents is a higher price than negative 19. Or in other words, negative 10 cents is less negative than negative 19 cents. So hopefully that didn't confuse you. Just keep in mind, buy low, sell high. And the fact that this is a negative number doesn't change that. Now, this is kind of confusing still, right? I mean, there's a lot to think about when trading options, and this just throws in one more thing to try and wrap your head around, but try not to let it confuse you. Now, this is what we consider a more advanced strategy because of, this confusing, the negative numbers, right? With an iron condor or a vertical or a strangle, that's much more cut and dry because we don't have to deal with any negative numbers. It's easy to quantify our profit or loss. It's easy to know what's going on, right? But since we have to deal with negative numbers with the broken wing butterfly or even the back ratio spread, it kind of just complicates things a little bit. So if you're still having trouble understanding the vertical spread and the iron condor, if you're new to those trades and you're still, trying to figure those out, then just go ahead and ignore the butterfly spread for now. Ignore this video. Don't try and learn the spread yet. It's going to just make things confusing and overwhelming. Stick to the vertical and the iron condor for now. But if you've got those figured out, hopefully this video will help you understand the broken wing butterfly. Anyways, let's talk about this. So we bought this spread at negative 19 cents. It is now trading at 10 cents. So we currently have a profit of 29 cents. Now, you can see we actually have an order in to close this trade at 25 cents. That's where we were targeting our closing trade. So that would have been a profit of, what's the difference between negative 19 and 25? that would have been a profit of 44 cents. Or since we traded one spread, that would have been $44. There's only 8 days left to expiration, so we're going to go ahead and close this trade, take what the market gave us. We would have preferred more, but, you know, it happens, right? You can't win big on every trade. Now, I also want to quickly mention that there's no right or wrong here, right? I mean, we could make a lot more money on this trade, and for us to make that money, the stock would have to go up to around 40, where the body of our butterfly is. It's currently at 38.50. It has 8 days to make a move up towards 40. If we look at the probability in the money on each of these strikes, you can see it has around a 7.5% chance of being at 40 at expiration. And, you know, so it's a low chance, right? But if it does happen, we would have a pretty big payout. So there's no right or wrong. You can hold the trade for a bigger profit if you like. Really, it just depends. If you're willing to risk 10 cents to make a lot more money, go ahead and hold it. But in this case, you know, if the stock stays right here and all these options remain out of the money, then this trade is going to go from 10, it's going to go to 0. So if we buy it at -19, sell it at 0, or in other words, we would just let it expire. But if that's the case, then we made 19 cents. But we're going to go ahead and salvage what the trade, you know, where it's trading for now, give us an extra 10 cents in profit. So we're going to make $29 instead of $19. Again, the choice is yours. But let me go ahead and walk you through how we're going to close this trade. Now, if you look at these options, you can see this far out of the money strike. And actually, let me go ahead. I'm going to cancel this order we have in right here where we were targeting 25 cents. We'll go ahead and cancel that because we're going to input a new order. But if you look at these options here, you can see this far out of the money strike, it's worthless. We are long this strike, so if we click position here, you can see we are long one contract, and since it's worthless, we don't need to sell that option. In fact, we can't really sell it. It has a bid of 0. Remember, we sell things at the bid price, we buy them at the ask price. So there's no reason to sell something for free, right? It's like giving it away for free. There's no reason to do that. So we're actually not going to close this leg of the trade. So the way we could close this order is we could actually just close these two options. So I'm going to walk you through how to do that. And we're going to do this a little bit differently than you would close most trades. Most of the time you would just right click the position, click create closing order. Now you can see the order to close the entire trade, but again, we aren't going to close this 43 strike call option because it's worthless anyways. So we're going to enter the order a little bit differently. What we're going to do, we're going to go ahead and close this up, and we're just going to build the trade to close these two options. Remember, we are long one contract of the 39 call, so all we need to do is we can click the bid price to sell this option. Okay, so there's the order to sell this option. Now what we need to do is we need to add the order to buy back the two contracts of the 40 strike call that we are short. So the way we do that is we hold the control key. Now let me show you what happens if you don't hold the control key. If you click the ask price to buy the 40 strike call, it will just replace the order. So again, we're going to bring up the order to sell the 39 call. Now, if we hold the control key and click the ask price to buy the 40 call, you can see it added that to our spread. Now, you can see the spread says vertical, and that's not really what we want because this is one contract. You know, we're selling one of the 39 calls, buying one of the 40 call, but remember, we are short two of these. So all we're going to do is we're going to change this vertical. We're going to change it to custom. So now we can customize the number of contracts. And if we click the plus button, there we go. There's our spread. Now, this is the order to close the trade, right? If we close this at 9 cents, we will have profited 19 plus 9. Close it, you know, buy at -19, sell at 9. If we click confirm and send, we could send this order and all is good and well. We made a small profit, move on to the next trade. But our commissions are $3, right? Because we have to pay a per contract fee of $1 for each contract. Now, guys, if you're not on the new rates, we sent out an email, I believe it was yesterday, on the new commission rates. If you're not on these new rates of $1 per contract, make sure you go ahead and follow the instructions and get on that rate, because it's going to save you a lot of money. It doesn't seem like a lot, $1 versus $1.50, but when it's per contract and you're trading almost every day, it adds up pretty quick. But anyways, back to the trade. We would have to pay $3 to close all these contracts. But there's a cool thing that TD Ameritrade does that you may not be aware of. What they do is, if you close a short option for less than 5 cents, they will waive the commission fee. And the reason they do that is they just want to add a little incentive to take your risk off the table, on your profitable trades, rather than trying to let them expire worthless. But the thing is, we can't really take advantage of that if we enter the trade as a spread. So again, this is the spread to close the trade. And in any other situation, if this option weren't less than 5 cents, we would submit this trade and close it. And if you don't really care about saving on commissions, you could go ahead and enter this trade. But we're going to do something a little bit different. All we're going to do is we're going to leg out of this trade. We're going to sell the 39 call, and we're going to have to pay commission on that. It'll be $1 commission. But then we're going to close the 40 call as a separate order, and we're going to save the commissions on those two contracts. So instead of $3 to close, it's $1 to close. Now again, it's a small difference, right? I mean, $1 versus $3. But if you can create good habits like this, just being aware of, how to maximize your returns as much as possible, all of these little things add up. So enough talking. I'm going to go ahead and place the trade. So again, we're going to sell the 39 call. We are long one contract. So if we review our order, we're going to sell one contract. This is the correct order. And let's see if we can get filled at 16 cents. You can see the bid is 15, ask is 17. And remember, since we're selling this, we want to get filled at the highest price possible. So we're going to try 16. If it doesn't fill, then we will cancel and move the order down to 15. So you can see we're on the ask at 16 right there, and we're not filling yet. While we wait to see if that fills, I'm going to go ahead and put in the order to close the 40 strike call. So we're short 2 contracts of this option. So all we're going to do is we're going to click to pull up the buy order, and we're going to change to 2 contracts. Now this one's just 1 cent wide between the bid and the ask. We're definitely not going to get filled at 3 cents, so we might as well go ahead and take the trade at 4 cents. We're going to click confirm and send, and this will fill instantly. So you can see we got filled on that leg of the trade. So still not filled on the 39 call. No biggie. I'm just going to go ahead and cancel replace, knock this down to 15 cents so we can get out of the trade. Confirm and send at 15 cents. So now we are essentially out of the trade. Again, we're long this option, but this is just going to expire worthless in 8 days. So just ignore this option. It doesn't matter. It's worthless anyways. But if we go over to our account statement, I'm going to show you guys our cash and sweep vehicle. And if you look at these trades, you can see the commissions and fees. So it charged us $1 to close the 39 call. But when closing the 2 short 40 calls at less than 5 cents, so we closed it at 4 cents, you can see the commissions and fees have been waived. So this is a quick little trick. If there are options that are less than 5 cents in your order, just go ahead and leg out of that trade. And, don't get fancy with it. Don't try and, close the short option at one point during the day. Try and let the stock rally before you close the long option. That's just going to mess, there's no edge in doing so, so don't do that. Just close it immediately. Once one of them fills, go ahead and close the other one, and that's a way to save commissions. Now, one more thing I forgot to mention. If you are trading a Tier 2 account, you're going to want to close the short options first. We're trading a tier 3 account, so it doesn't matter. But if you close the long option before the short options, that will leave you with a short naked call. So you don't want to do that in a tier 2 account. So, alright guys, I'm going to end the video here, and I will see you in the next video.